In this video, I want to circle back and talk about 2018 as a whole and what's happened so far this year in the markets. I'm going to go back and look at some of the previous articles that I've written at nextbigtrade.com. The first one is from January of this year, where I talked about going to cash and how the market was overdue for a period of increased volatility. And at the end of January, that's exactly what I did. And we saw the S&P 500 have a major correction starting in February, and that really ended the first wave of the stock market correction, and we've really just been consolidating sideways ever since. I talked about in February how the market had basically its fastest 10% correction ever, according to a chart I found from Yardini Research. And we were actually due for the typical bottom for that. A 10% correction would have occurred in May of this year. So if you take this whole correction as a whole, we're now past kind of like the median time for your typical 10% correction. But if you go back and look at what happened to the market in 2015 and into 2016, and this is about like a 15% correction, but you can see how long it took the market to digest the major gains from 2013 and 14 in this sideways bear market, where a lot of subsectors of the market like energy lost way more than 15%. A lot of foreign stocks got hit hard, but overall the broader market took a little over a year to really digest the gains in a sideways bear market and then reassert itself into a stage 2 bull market in late 2016. And then later this year, I started really focusing on the software sector at nextbigtrade.com, and this has turned out to be one of the leading sectors so far this year in the market. If you look at the IGV ETF and the HACK ETF, they've both been one of the biggest performers this year in the market. And the reason I highlighted software was because of the fact that it really hadn't exerted leadership in the tech sector for a long period of time. And we finally saw it break out in 2017, and the rally really continued into 2018 so far this year. But this really brings me to where we're at currently, and even though we've seen software and a lot of the tech stocks perform pretty well so far this year, the problem right now with the current market is that these leadership sectors are starting to get hit hard, and this is also occurring at the same time when the S&P 500 is trying to break out into new highs. So if you look at one of my latest articles, Why the Current Market is Treacherous, I talk about how the major stock market indexes are still in uptrends and trying to make new highs, but we're seeing leading sectors in the market and leading stocks in these leading sectors are underperforming and actually selling off pretty hard. And really, for the market to be in a healthy condition where it's easy to make money in explosive growth stocks, you want to see not only the major indexes making new highs, but you want to see leading sectors and leading stocks in those sectors really performing well. And that makes the market right now a much more dangerous place than it normally is. Now, some of the major signs of unhealthiness in the market are the fact that foreign and emerging markets are in stage 3 and stage 4. The financials are chopping sideways in stage 3, and there's a low amount of stocks kind of breaking out in the new highs, and you can see this on the watch list page on the stage analysis screener, and also the health page. You'll notice that there's more sectors weakening than strengthening. So I'll look at the stage analysis screener really quick and go and take a look at some of this stuff. But if you look at the indexes page, You can see that foreign and emerging markets, you have barely any of these ETFs are in stage 2. They're all in stage 3 and stage 4. If you talk about US stock market sectors, you can see that technology and consumer discretionary, XLY and XLK, are both have been in stage 2 the longest, but you have things like materials and industrials kind of moving sideways, very choppy, and then also financials moved a little bit higher last week, but they're still kind of trapped in the sideways trading range. So again, what the problem is with the current market is that it's trying to break out to new highs, but there's barely any stocks that are really set up to like lead it higher right now. And on top of that, some of the leading stocks in the overall market, like Facebook, Twitter, Netflix, really got slammed hard on big volume over the last couple of weeks, and it's going to take a lot of buying pressure to overcome selling pressure like that. So even though Apple's probably going to make a new high when the market opens tomorrow, but it's going to be interesting to see how that stock performs, and in my opinion, it's probably going to be hard for that stock alone to carry the overall market higher. Now, some of the other ETFs I'm looking at, like I'm paying close attention to these foreign markets. Japan, EWJ, you can see how it still is trending below the 30-week moving average. China, FXY, still just below the 30-week moving average. Not what you want to see for leading, emerging market. Look how well it did in 2017, and it struggled, for basically the entire year so far, 2018. And really what's happening is the U.S. markets are kind of finally coming under pressure, even though they've tried to maintain above the 30-week moving average while these foreign markets have been selling off. And again, the financials, XLF, notice how it's just treading water right now. If this market does continue higher, then that's going to be a great sign for the overall market. And if it breaks down, then there's going to be more selling pressure to come in the overall market. And really, overall, I want to maintain flexibility though here, because leading stocks can always set up at any time, and the market can change. So, we're just looking at a trading range here. I think there's a good chance that we're going to go down and retest the bottom of this trading range sometime within the next 2 months, given the fact that leading stocks are not acting well right now. But there's no reason that they can't kind of digest, move sideways, and then set up later on this year. And so I'm not going to get I'll get more bearish when the market rolls over below the 30-week moving average. But again, I'll look for these first levels of support to hold, and that could probably maybe end this sideways bear market correction, which could, obviously kick off another strong up leg in the market maybe later on this year or next year.